Welcome back to the deep dive. Today we are wrestling with, well, a true market puzzle.
We really are.
We're diving into YASH High Voltage Ltd, ticker YSHHV.
Right, a microcap company in that niche power equipment sector.
And they have just this almost unbelievable story of fundamental growth.
Unbelievable is the word. But then you look at the stock price.
And lately it's just stopped moving. It's gone flat.
And that contradiction is really the heart of this deep dive. You, the listener, you gave us this fantastic stack of sources.
We have it all here. A detailed technical chart analysis sitting right next to a really comprehensive review of the last 12 months of news, orders, all the financial reports.
And it's a tale of two completely different stories.
It is. If you read the company's recent earnings reports, I mean, it sounds like a rocket ship on the launch pad.
Absolutely.
But then you look at the chart, say, since last summer, and the price action looks like it's floating in the Dead Sea.
So our mission today is to figure out why. Why are these two realities so divergent?
What happens when that incredible high-octane growth hits what feels like a wall of market exhaustion and valuation caution? Okay, let's unpack this.
This specific deep dive is so crucial because YASHV is right in that sweet spot. You know, high risk, high reward, small caps.
And what do they actually make?
They make high voltage gear, transformer bushings, basically essential components for this massive global push in power infrastructure.
And transmission modernization.
Exactly.
Yeah.
So to really get it, you have to reconcile the technicals, the how the stock is moving, with the powerful fundamental drivers, the why the company is growing at such an insane clip.
Okay, let's start there. Let's start with the undisputed good news, the fuel for this whole story, the fundamentals.
Right.
Looking at the financial performance over the last few years, the data is just, well, it's extraordinary.
It really is.
When we look at the annual sales growth, we're seeing figures near or even above 40%.
And that's throughout fiscal year 2024 and heading straight into 2025.
And if you zoom out for a longer-term view, I mean, that consistency is what's so impressive.
That's the key. The company's 3-year revenue compound annual growth rate, the CAGR, is comfortably above 30%.
For anyone unfamiliar, can you just quickly break down what KGR means?
Sure, it isn't just one good year. It's the smooth, annualized rate of return you'd need to get from that starting number to the ending number over 3 years.
So sustaining 30% plus growth, especially in a capital goods sector, that's elite.
It positions them as an elite, high-growth, niche power equipment player, no question.
And that operational excellence hasn't flagged at all, which is why the market is sort of holding its breath.
Mm-hmm.
The latest reported figures we have for the first half of fiscal year 26, so that's the current financial year, show revenue increasing roughly 75 to 80%.
Year on year, compared to the same period last year. Just think about that number for a second.
It's a staggering percentage, and they're not just growing revenue at that pace.
No, they're doing it while maintaining exceptionally healthy net margins. This isn't growth at any cost.
It's quality, profitable expansion.
And that level of operational performance is why the stock, despite its recent pause, has been such a stellar performer overall.
That context is vital. Over the past year, the stock's overall gain has been in that same stratospheric zone, right? Around 75 to 80%.
It has.
And if you compare that to the broader Sensex index, which saw, what, low single-digit return?
Yeah, basically full.
This company has just massively outperformed. It was the definition of a market darling.
Was. Until recently.
Right. And the market also loves the stability that's reflected in their balance sheet.
Oh, absolutely. Reports repeatedly highlight strength there, particularly low debt to equity. It's sitting around a very conservative 0.2 to 0.3.
So what does that mean in simple terms?
It means for every dollar the company holds in equity, they only owe 20 or 30 cents in debt. They are not over-leveraging their expansion at all.
You also see the profitability reflected in shareholder value. What can you tell us about those high ROE and ROCE figures we saw in the sources? Because 30 to 45% sounds phenomenal.
It is phenomenal, and we really need to pause on that number because it defines the quality of the company.
Okay.
ROE is return on equity. ROCE is return on capital employed. To generate a return on equity in that 30 to 45% range, well, it essentially means that for every dollar of capital invested by shareholders, the company is generating 30 to 45 cents in profit.
That is an incredibly efficient use of capital.
A massive driver of long-term value creation.
So that's management just firing on all cylinders. Now, let's look at the strategic direction that's supposed to sustain all this growth.
Right. The corporate actions over 2025 were a clear signal of their ambition.
We saw three major steps, right?
Three major steps that the market viewed as catalysts. First, a contract win of around 11 to 12 crore rupees.
Which adds immediate revenue certainty.
Exactly. Second, an MOU with Electrolink Power Solutions, which suggests deepening their domestic or maybe regional partnerships.
And the third one, which felt like the biggest signal of future intent, was that board approval for incorporating a U.S. subsidiary.
That is a huge strategic pivot for a niche microcap like this.
It is.
It's the move that fundamentally changes the risk-reward profile. The U.S. is a mature, but, a vast market for power infrastructure.
With higher margin opportunities, too.
Often much higher.
Yeah.
So opening a U.S. subsidiary, that signals a really serious commitment to deepening export markets and widening that order book beyond its traditional zones.
And success there means the difference between being a good domestic growth story and becoming
A global, high-margin player. That's the dream.
Okay, so given they have these huge expansion plans and their balance sheet is so healthy with such low debt, I have to ask this. Is it possible they're being too conservative?
That's a great question.
Are they missing out on cheap expansion capital by keeping their debt to equity so low?
It's a fair point, and it really speaks to the small cap environment. In this space, the market often rewards financial discipline over aggressive leveraging.
Especially when you're gearing up for a big global expansion.
Exactly. We also saw relatively conservative news on other corporate actions. A small final dividend, just 1 rupee per share, and small promoter holding increases.
Which signals management confidence, but
But it avoids any moves like aggressive equity issuance or taking on high leverage. That would spook the market during a correction. They're choosing stability over speed, maybe.
which is a smart long-term signal.
I think so.
So we have a pristine, rocket-fueled fundamental story, 75% growth, 45% ROE, global expansion plans, rock-solid balance sheet.
The whole package.
And now we take that incredible set of facts and we turn to the technical chart. And this is where the puzzle gets really complicated.
It's the complete counter-narrative. The big, aggressive rally happened over just 4 months.
March to mid-July of 2025.
Right. That was the period where the market was aggressively buying the fundamentals we just described. The price rocketed from the 150, 170 rupee zone all the way up to an all-time high near 615.
That confirmed a massive, powerful primary uptrend, no doubt.
No doubt at all.
But since that July peak, the party just stopped. The strong primary uptrend has transitioned into what technicians call a sideways to mildly corrective phase.
Exactly. For the last several months, the stock has been locked in a relatively tight range, just oscillating roughly between 430 and 550 rupees.
This is what we call consolidation.
It is. And it's the chart's way of just taking a breath after an extreme run-up.
And the moving averages, they confirm that the upward momentum has truly stalled out. The stock is now trading close to or just below the 50-day moving average. For the listener, what does it mean when that 50-day average starts flattening out like this?
That flattening is the technical chart's clearest way of saying the initial spring rally is over and we've lost the momentum.
Okay.
When a stock is trending strongly, the price bounces off that rising 50-day MA. When it flattens, it just means the price has been trading horizontally for long enough that the average of the last 50 trading days isn't rising steeply anymore.
So it signals the emergence of a range.
And a definite loss of conviction among buyers.
Let's define the critical price anchors that you identified in the source material, because these are crucial for knowing which way the stock breaks next. Where is the safety net here?
The safety net is the critical support zone. It's sitting immediately around 430 to 450 rupees.
And why there?
This zone aligns with recent swing lows, and it represents the level where the most recent set of buyers stepped in. The technical analysis sources are pretty clear. They warn that a decisive close below this level could open up a much deeper correction.
Especially on higher volume.
Especially on higher volume.
And how deep are we talking if that happens?
If that 430 to 450 support fails, the correction could likely stretch down toward the 380 to 400 rupee area.
And that level is strategically important because
that's where the 200-day moving average, the main long-term trend indicator, and the earlier breakout region both lie. That is the major structural support that needs to hold to keep the long-term uptrend intact.
Okay, now what about the other side? What defines the critical overhead resistance, the ceiling they can't seem to break through?
The overhead resistance is very visible near 520 to 550 rupees. This zone aligns with repeated failure points since that July peak.
The stock has tried and failed to climb back above 550 multiple times.
Multiple times. And until it can punch convincingly through that ceiling with strong buying interest and, importantly, volume, the short-term outlook just remains that range-bound consolidation we've been seeing.
We're seeing this pause, but if we look at the momentum indicators, the RSI, the MACD, are we seeing outright panic selling, or is this just a rest?
It's clearly a cooling phase, not a capitulation. The Relative Strength Index, or RSI, is sitting around the mid-30s.
Which reflects weak momentum.
Very weak momentum. It means buyers aren't aggressive, but it's not deeply oversold, which would signal panic. The MACD is slightly negative, confirming that short-term downtrend within the consolidation.
And the volume context supports that idea of waiting, too.
Exactly. Recent sessions show relatively low to average volumes in this consolidation band. Low volume and a sideways movement is classic behavior for a stock that's just waiting for the next major catalyst.
So it suggests neither strong accumulation by institutions nor widespread selling by current holders.
Everyone is just watching the door.
Here's where it gets really interesting. We have this 75% year-on-year revenue growth colliding with the stock price that has been stuck in neutral for months, sitting right below that critical resistance of 550. What is the fundamental reason for this stalemate?
The stalemate is valuation risk. That is the point of tension.
So all that good news.
All of the incredible fundamentals have already been priced into the stock. Despite those robust numbers, every major screener and broker report flags this stock as richly valued.
Let's put some gravity on those numbers. What does a trailing price-to-earnings ratio above 50 to 60 and a price-to-book value near 8 or 9 actually mean for the listener?
It means the market is not just betting on the company being successful next year.
No.
They are demanding financial perfection for the next 5 to 10 years. A PE of 50 means investors are paying 50 times the company's current annual earnings for one share.
They're factoring in multiple years of that 75% growth rate today.
Exactly. The price has raced so far ahead of the current earnings that the stock is now structurally capped until the earnings physically catch up to that demanding valuation.
That makes perfect sense. The market is basically saying, I believe the story, but I need the numbers to prove it before I give you any more money.
That's it in a nutshell.
Yeah.
And layered on top of that high valuation are those specific risks that are just inherent to being an early-stage, fast-growing small cap.
Right.
Commentaries note that while the balance sheet is strong, it operates in a bracket where earnings volatility and liquidity risk are elevated.
So if they miss 1/4 of that aggressive growth forecast, the downside correction could be swift and sharp.
Precisely because the valuation is so high, there's no room for error.
And this brings us back to something you mentioned earlier, the importance of cash flow. Why must the market monitor free cash flow and capital allocations so closely, even with such a high ROE?
Because high revenue and high profit don't always translate immediately into usable cash.
Right.
In a capital goods company that is growing aggressively and entering new markets like the U.S., a lot of capital can get tied up.
In inventory, receivables.
Money owed by customers, upfront investments for that U.S. subsidiary. Free cash flow and the conversion of high profits to cash, it all needs to be flawless.
And if capital allocation slips.
If that U.S. venture costs more than expected or if customers pay slowly, it puts pressure on a stock that simply cannot afford any pressure right now.
Okay, so given this intense pressure cooker of valuation, what does a fresh, constructive, or bullish signal look like? How does YASHV break out of this phase?
A fresh bullish leg requires 3 things to align perfectly. First, on the technical side, the price has to successfully defend that key 430-450 support zone.
It has to hold that line.
It has to hold. Second, momentum needs to reset. The RSI has to turn back decisively above 50, signaling that buyers are stepping back in aggressively.
And
we need a daily close above that 525.50 resistance band, and crucially, on expanding volume. That high volume would confirm that the waiting period is over and institutional money is ready for the next move up.
And on the flip side, what triggers the risk of a deep correction, the bearish scenario?
The immediate risk is a sustained break below that 430-450 support with rising volume. That would shift the outlook to that deeper correction toward the 380-400 zone.
And fundamentally,
the triggers are clear. Any slowdown in order inflow, a reduction in the broader power sector's capital expenditure, or especially any margin slippage while they're executing their global expansion plans, any of those could cause a sharp derating.
Because of the elevated multiple.
Valuation just can't handle bad news.
So if we boil down the overall feeling from the sources, it's a positive structural story, but we are hitting a critical patch of caution.
Exactly. It's a structurally strong growth story, fueled by secular tailwinds in power and transmission infrastructure globally. But future returns, particularly from this current high price, will depend entirely on sustaining that high double-digit growth.
And executing their strategic plans perfectly.
Perfectly. Especially the U.S. subsidiary rollout. The valuation demands nothing less than exceptional performance.
So what does this all mean? Our deep dive into Yash High Voltage, it shows a high-octane growth story that the market has fully acknowledged and, more importantly, fully priced in.
I think that's the key.
The current consolidation and sideways movement is the market shifting its stance. It's no longer buying the story, it is now strictly demanding the proof.
And the short-term outlook, based purely on that technical analysis, is continued range-bound action with a slight downward tilt. Gravity is always pulling against a high valuation.
Unless that key 430 to 450 support holds and we get that clear high-volume breakout above the 550 ceiling. For you, the listener, the critical knowledge nugget here, whether you are looking at YASHHV or any other high-growth small cap, is the immense importance of cash conversion.
That is the ultimate test. Given that the company's valuation relies so heavily on flawless future growth, justifying a PE above 50, the true long-term challenge lies in whether that new U.S. subsidiary can open higher margin markets and sustain the growth rate needed to make the current price seem cheap 5 years from now.
So the real question is, can the earnings catch up to the price quickly enough?
Or is a prolonged, maybe even painful, consolidation necessary for the fundamentals to mature into the ambitious valuation that the stock already carries? That gap between the price and the execution is the current fascinating challenge.